This AI-generated podcast is for general information only and does not constitute financial or legal advice. Listeners should independently verify all information. Please consult a qualified professional. Welcome to the Luxembourg Fundcast, produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris. This show brings you reliable insights on Luxembourg regulations sourced from curated official references. Please note that this episode is current as of 21 June 2026. It is a frequent compliance reflex. A client profile registers an elevated indicator for money laundering or terrorist financing risk, and, well, the institution immediately denies onboarding. That seems like the safest road. But under Luxembourg law, treating risk avoidance as risk management is a procedural deficiency. Today, we are analyzing the regulatory expectations surrounding the management of money laundering and terrorist financing risks, with a specific focus on de-risking mandates.
Right, and to frame this discussion accurately for practitioners, we first need to define what the regulator means when they refer to de-risking in this context. De-risking is the practice where financial institutions choose to exit or refuse entire categories of clients, products, or services to avoid managing the associated regulatory risks.
Which, institutions often view as a standard protective measure.
Exactly. However, the Commission de Surveillance du Secteur Financier, or CSSF, views this differently.
Which brings us directly to the primary thesis you must operationalize. A higher risk of money laundering and terrorist financing does not by itself justify excluding an entire category of clients, products, or services. The core principle we will examine today is that the mechanical avoidance of risk is not a substitute for effective risk management.
Yes, and to properly implement this standard within your internal frameworks, we must examine the formal legal references that govern it. This requirement is articulated in the communication of 16 June 2026 by the CSSF. Furthermore, the foundational compliance obligations are established in the amended law of 12 November 2004 on the fight against money laundering and terrorist financing, alongside CSSF regulation No. 12-02 of 14 December 2012.
Okay, and for the duration of this briefing, we will refer to these instruments as the Law of 2004 and CSSF Regulation No. 12-02. Let us look at the rule clarification, which is highly specific. A general exclusion of a client category is acceptable only where applicable law or regulation expressly requires it.
Precisely. Any such requirement must be strictly referenced within frameworks like the Law of 2004 or CSSF Regulation No. 12-02.
But as practitioners, we frequently see institutions default to blanket refusals simply to save on administrative overhead. How does the regulator precisely differentiate the mechanical avoidance of risk from the active management required under these specific instruments?
Well, the differentiation lies in procedural workflow. Under the Law of 2004 and CSSF Regulation No. 12-02, the regulatory expectation demands active management as the baseline operational standard. Mechanical avoidance is characterized by the implementation of a blanket refusal applied uniformly to an entire demographic or business sector.
So it bypasses the required analytical framework completely.
Yes, it does. Active management, conversely, requires institutions to evaluate the distinct risk profile of each counterparty and apply structured, individualized assessments.
Okay, so when a compliance team identifies a higher risk profile, the required regulatory response is active management through proper controls. Higher risk necessitates management, not evasion. But practically speaking, reviewing a high-risk profile requires extensive administrative resources.
It does, yes.
Why is the regulator prohibiting an institution from setting a baseline risk appetite that simply excludes these complex profiles from the start?
Because a unilaterally defined risk appetite cannot supersede the legal obligation to conduct individualized assessments. The CSSF framework dictates that financial inclusion and proper risk evaluation must take precedence over broad administrative convenience. You cannot use your internal risk appetite as a shield to bypass the statutory requirements detailed in the Law of 2004.
That sets up our first key takeaway, which is targeted specifically at Luxembourg banks. If blanket refusals are prohibited under the Law of 2004, we need to examine how banks are expected to process these high-risk indicators in practice. The core rule dictates that banks are required to assess the customer risk profile strictly on a case-by-case basis.
Right, and for Luxembourg banks, identifying a higher risk operates as an indicator that mandates the application of enhanced controls.
So it does not validate an automatic refusal of onboarding.
Correct, it does not. You are required to process the variables of each profile individually.
Let us examine the mechanics of that requirement. From a clinical practitioner perspective, what is the exact operational distinction between applying an enhanced control and issuing an automatic refusal? How does a bank execute one without inadvertently doing the other, while strictly maintaining the required focus on the case-by-case evaluation.
The distinction is demonstrated by the procedural methodology utilized by the bank's compliance department. Issuing an automatic refusal terminates the onboarding or review process based on a broad classification.
Like rejecting an applicant solely because they operate in a specific industry.
Exactly, without any further review. This completely removes the case-by-case assessment from the procedural workflow. Conversely, applying an enhanced control requires you to analyze the individual data provided by that specific applicant.
Could you detail what that analysis looks like operationally? If an institution cannot refuse them based on industry alone, what are the exact steps the compliance officer must take?
First, you must isolate the specific risk indicators for that individual customer. Is the risk driven by their geographical location, their transaction volume, or their corporate structure? Second, you must deploy corresponding measures to mitigate those exact risks.
So that could involve requiring additional documentation regarding the source of wealth or increasing the frequency of transaction monitoring.
Yes, precisely. The case-by-case requirement ensures that operational decisions are formulated on individualized data rather than generalized categorizations. You must demonstrate to the regulator that you attempted to manage the specific risk presented by the client before making any final determination.
Right, which introduces a significant operational friction, leading us to our second takeaway. This takeaway addresses the core distinction between rare supervisory de-risking and the standard commercial exit strategy. The CSSF enforces a distinct separation here. If applying enhanced controls costs considerable time and money and the risk remains high, how does the CSSF expect a bank to legally terminate a relationship that simply is not financially viable?
Well, the regulatory framework distinguishes these exit processes based entirely on their underlying operational drivers. A profitability-driven withdrawal is recognized strictly as a business model decision. It is an economic calculation regarding the institution's operational viability.
To clarify the operational parameters for you, a commercial exit is not the same as noncompliance with rules regarding money laundering and terrorist financing risk management. But from a practitioner's view, the line between an economic exit and a risk avoidance exit appears remarkably thin. If a client is highly complex, the cost of compliance inherently rises. So how is a profitability-driven withdrawal distinctly categorized away from noncompliance in this context?
It is categorized independently because the driving factor must be a demonstrable economic calculation, not the evasion of risk management procedures. A profitability-driven withdrawal is an action based on commercial variables. If you calculate that the administrative cost of maintaining a business relationship, which includes the cost of required analysts, monitoring software, and enhanced due diligence, exceeds the revenue generated by that relationship, concluding that relationship constitutes a standard business model decision.
What documentation would the regulator expect to see to prove that the termination was an economic calculation and not a circumvention of the risk assessment?
You would need to provide internal financial metrics. This involves documenting the projected revenue of the account against the quantified cost of the compliance resources required to maintain it.
Understood. So noncompliance occurs when an institution cites money laundering risk as the primary reason for termination without conducting the legally required assessment.
Exactly. Or when they use a vague commercial rationale to mask what is actually a blanket de-risking policy.
We should reiterate the core thesis here to ensure the boundary remains clear. While a commercial exit is a valid business decision based on administrative costs, an exit driven solely by money laundering and terrorist financing risk, executed without a case-by-case assessment, remains an unacceptable blanket exclusion. You cannot use a commercial exit as a disguise for mechanical risk avoidance.
That is a critical point. The regulatory scrutiny will focus on whether the economic calculation is applied consistently across your operations or if it is only being utilized to quickly dismiss higher risk profiles that you prefer not to manage.
This requirement extends beyond the banking sector. Our third takeaway shifts the focus to fund sector actors subject to money laundering and terrorist financing risk management obligations. This framework is governed by Circular CSSF 23-842. The expectations regarding documentation become highly prescriptive here.
Yes, for actors operating within the fund sector, these obligations manifest directly as a strict evidencing requirement. Any formal decision you execute to accept, refuse, or exit a relationship must be heavily documented. The decision must be proportionate and consistent with the specific requirements detailed in Circular CSSF 23-842.
There are strict practical implications regarding these file requirements. First, the file must show the information requested and the alternative measures considered. Second, the file must document the residual risk assessment and the precise reason for the decision. Let us examine the first element. If an institution ultimately refuses onboarding, they still have to document the alternative measures they considered but did not use. Why is the regulator mandating the documentation of a hypothetical control?
To prove that the institution genuinely attempted active management before resorting to a refusal, the file must demonstrate that you actively look for ways to safely onboard or maintain the client.
So you must document what specific enhanced controls were evaluated.
Yes, and formally state why those controls were deemed insufficient to mitigate the identified risks. This proves the refusal was the result of a failed mitigation attempt, rather than a mechanical avoidance of the profile.
That brings us to the remaining elements: documenting the residual risk assessment and the precise reason for the decision. Could you break down the exact mechanics of calculating residual risk in practice? Under Circular CSSF 23-842. How does a compliance officer actually weigh an enhanced control against an initial risk parameter to reach this residual score?
Documenting the residual risk assessment requires a systematic operational workflow. First, you must formally log the initial risk parameters that were identified before any controls were applied. This is your inherent risk. Following this, you must document the specific alternative measures or enhanced controls that were applied or considered to mitigate those initial parameters.
And the final step is evaluating the effect of those controls.
Yes. Finally, you are required to evaluate the risk that remains after those controls are factored into the equation. This is the residual risk. Subject to the regulator's interpretation, the documentation must demonstrate that the remaining risk was analyzed clinically.
Meaning you must explain exactly why the residual risk remains unacceptably high despite the proposed controls.
Precisely. Furthermore, this specific analysis of the residual risk must form the precise operational reason for the final decision.
So if the file simply states that the client was rejected due to high risk, without showing the mathematical progression from inherent risk through the applied controls to the residual risk, the institution is failing the evidencing requirement of Circular CSSF 23-842.
That is correct. A generalized statement of risk is not sufficient evidence of active management. The regulator expects to see the procedural logic that led to the final determination.
We must now examine the future application of these regulatory standards as the framework governing these procedures is expanding at the European level. This introduces Article 21.4 of Regulation EU 2024-1624 of 31 May 2024.
Yes, the future regulatory parameters regarding how institutions handle these risk profiles will be directly shaped by Article 21.4 of Regulation EU 2024-1624. This article recognizes the friction caused by de-risking practices across the market.
And it mandates that joint guidelines must be issued by two central bodies, the Anti-Money Laundering Authority and the European Banking Authority.
Exactly.
These joint guidelines are required by 10 July 2027. We know that these guidelines will address the business relationships most affected by de-risking practices. How should practitioners prepare for the implementation of Article 21.4 of Regulation EU 2024-1624? What exactly are these authorities aiming to resolve?
Well, these authorities are aiming to resolve the inconsistency in how active management is applied across different jurisdictions and sectors. The guidelines issued under Article 21.4 of Regulation EU 2024-1624 will likely provide more granular instructions on what constitutes an acceptable enhanced control.
And perhaps how far an institution must go in their alternative measure considerations before a refusal is deemed legally compliant.
Yes. Exactly. But until those guidelines are published on 10 July 2027, practitioners could apply the current case-by-case assessment standards we have discussed today, strictly adhering to them.
The forthcoming issuance of these guidelines serves to reinforce our primary thesis one final time. European authorities are actively providing increasingly detailed regulatory frameworks because the mechanical blanket exclusion of client or product categories is not a valid substitute for precise risk management. Higher risk must be managed through continuous, individualized assessment backed by rigorous evidencing of your residual risk calculations.
The regulatory trajectory is clear. As the financial sector evolves, the expectation for institutions to process complex risk data on an individual basis will only increase. Institutions must ensure their compliance workflows are designed to evaluate and mitigate risk actively, rather than mechanically avoiding it.
Thank you for listening. To support this work, subscribe on Spotify, Apple Podcasts, or wherever you get your podcasts, and on our YouTube channel, Bertrand Mariaux. Follow and connect with Bertrand Mariaux on LinkedIn. Your comments and likes are welcome there. To read the full analysis of the article, visit our website, bertrandmariaux.com. Note that you can also listen to the French edition, the Luxembourg Fundcast. All links are in the description. This was the Luxembourg Fundcast.